Welcome to the Money to the Masses podcast, putting you in control of your finances. One mic, two idiots, and, according to our latest figures, 3 listeners. Here are your hosts, Damien Fay and Andy Leeks.
Hello and welcome to episode 104 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, good to see your face again.
It's good to see yours, Andy. It's good to be back.
Yeah, what have you been up to, mate?
Busy. I've been hectic this week. It's one of those things when you create something and you want to follow a passion, and obviously for me it's Money to the Masses. You'd think, wouldn't you, that you would do something that perhaps
you enjoyed?
No, I do. I love it. I enjoy it. That's why I do it. And but where you aren't on a Friday night, because as this is Friday night, Andy, we are late on a Friday recording this podcast. Just to give a bit of insight to this, Friday is a nightmare day for me and what I do. I'm so busy, and to put this into context, today I've been doing a lot of stuff on 80/20 Investor in terms of we've done a new update that enables people to search the funds even more easily than they did before my portfolio. I did a portfolio review. That portfolio is up nearly 16% in just 18-19 months, which is an amazing result. I'm really chuffed with that, because compared to the market and the average fund managers they're up way less than 10%, I am beating them, which is brilliant. I mean, these professional managers get paid a fortune to do this, and I'm teaching people how to beat them at their own game. But of course I was doing all that, and then I ended up doing the new YouTube videos we're doing, the news roundups, this podcast, the newsletter that I've got to do after this for 80/20 people. I'm absolutely mental on a Friday. Friday is the busiest day of the week for me. I should have done it the other way around. You know, when you're full of energy at the beginning of the week, I have to do my life in reverse.
No one says Friday has to be the end of the week. They're only saying that because that's the norm, isn't it? People work. Most normal people work Monday to Friday. You can switch that up. You work for yourself. You can call Friday the beginning of your week.
Yeah, I like that. You said the most normal people. I'm going to take that as an insult, because by definition you're saying that I'm not normal, but maybe I'm not. So, no, I'm really good, Andy, in answer to your original question, but busy as hell. So that's great, though, because we're doing so many new things on Money to the Masses. Even going to be doing some Facebook Live stuff. So that'll be interesting.
Maybe we could even do a Facebook Live one day when we do a podcast. Let people in to see 5 minutes of our show and how we put it together.
Do you know what, Andy? That'd be brilliant. We should do that. If people want us to do a Facebook Live for 5 minutes of us recording the show, then tell us and we'll do it. And we'll arrange a time to do it so people can log on and watch it. Because I think there's some people who would. They can see you and I laughing, and probably a few outtakes going on as well, and drinking tea. So I'm not going to promise it's going to be the most riveting thing, but you see how it works. Anyway, Andy, what have you been up to?
I've been up to not very much, my friend. Busy at work, busy at the day job, and not doing a lot in the evening. I've had typical man flu. I've been trying to lose a bit of weight, and helping my children with their homework, that kind of thing. Just doing normal, average sort of day-to-day stuff. But really tired with it, though.
Oh, so it wasn't you who won the Nobel Peace Prize today, then?
Do you know, it wasn't. And the amount of letters I've written to those guys. No, it wasn't.
Right, talking about inspiring things, Andy, that's kind of a theme for this week's podcast, okay? There is, it's all about investing, but the reason I actually thought about what to do today is that, do you remember last week I talked about I did some work for some new financial advisors and young financial advisors, trying to teach them how to engage the public and teach them about money and thinking about money differently.
Yes, indeed.
I wrote about it in my newsletter, because every week on my newsletter, if you don't get my Money to the Masses newsletter, which is a roundup of all the top stories that you should be worried about and should have an eye on, then sign up to it. It's obviously free on the website moneytothemasses.com. It comes out every Sunday morning at 10 o'clock, even with a newspaper roundup of all the money sections of the national newspapers in there. But I also normally put an intro, a commentary, something that is some musings, as it were, Andy. And I started talking about the idea of me trying to reform the finance world. And I was just talking about that whole piece that I did where I did the presentation to these guys and trying to teach them about how to engage with people and think differently about their skill set rather than being financial advisors who get paid in a certain way. Why not think about ways of exploring, basically like I did, doing something different? And I got a really nice email from a lady who thanked me. I actually tweeted it, so you go on Twitter and on Facebook, not the whole letter, just the closing paragraph to keep her anonymous, because there's a really nice ending to it, but basically thanking me for inspiring her to go into financial advice, because she wants to try and make a difference in terms of educating people about money. So that made my day. That is brilliant, because it's that sort of thing we're trying to do, whether it's we're educating people about money or if we're trying to educate the industry. And one of the things I'd love to do is slowly try and reform the world of finance so it stops being this world where you have to pay to find out what they know. I'd rather it be like we do. We tell people what we know, and that's the way I think business should be built and the city should work. And of course that's what the whole piece was about, and it inspired her. So taking that, I got another email about somebody who's inspired to invest and get into investing. So taking the whole idea of inspiring people and investing, I've decided that this week we're going to do something slightly different, but a bit more of a journey. So like that lady starting a journey into becoming an advisor, this is about becoming an investor, so running your own money. Now, in the past, Andy, we've touched upon a lot of stuff, don't we? We cover lots of topics and people thank us for all the different bits we educate them about. But what I want to try and do is do it from a point of you're starting today with some money, don't know what to do with it, and how you end up becoming an investor or get started. So it's trying to do it in a one piece. And along this route, I'm going to talk about what you might invest in, how you might do it, things like fund platforms, what to look for on those, how to pick them, whether you should have an ISA or a pension, and blah blah blah. So we're going to do that, Andy.
Excellent. So it's like the winding it back a touch and going from the journey right from the very start, point to point, and giving a few tips along the way.
Yeah, it's like investing 101. So let's get started, and you jump in,
Andy. Is that different to Room 101? Because that's a very different
It's just
place.
next door. Actually, it's the floor above.
Okay, lovely. Okay, Investment 101. Damien, shoot, I'm all ears.
Right. Do you know what? One of the biggest flaws, I think, about the world of financial advice is that if you want to invest money, what happens is you go to a financial advisor, okay, and you have you might even know you have a problem, but what they will do is they will try and sell you something, and they will tell you it's advice, and some of them are very ethical, so they will say to you, Andy Leeks, you've got X amount of money, I think you should invest it today doing this is how you're going to do it, and this is what you're going to invest it in, and so forth and so forth. The problem is, I think the world of DIY investing and how consumers think about these things is the opposite way round. Now, the reason why advisors like the way they do it is because they see it from their point of view. They've got like these holes to put you in. So you've come to, all right, you're wanting an investment. Okay, I'll plug you in there because that's how I get paid. And it goes down a very set decision tree. Whereas when you go and invest, you think of it from the bottom up, really. You decide what you want to do, and you may have an idea of what fund or what you want to invest in, and then you think, oh, how do I do that? A bit like if you want to buy a car. You decide what car you like first, and you think, well, how am I going to buy it? So this is my theory on how people should invest. So I'm going to start from the bottom up, okay? I'm going to start from the what you're going to buy. Rather than thinking about how you're going to buy it, I'm going to think about what you're going to buy first. So it's a different way to financial advisors, and I think the right way. So I was asked a question by somebody who said they had £25 to invest a month. Okay, they are young, I think they were in their 20s, didn't really know what to do, didn't really understand how they'd get into it, but they knew they wanted to start. So a quick rundown of what to invest in. Okay, you could stick your money in cash, and now they'd already ruled that out because they wanted to try and earn more, and they're happy with investment risk. So I'm assuming you're happy with that.
Okay.
Now, one of the things people might do is they automatically think, well, do I buy shares? So buy shares in a company. Park that idea, because for most people, that is very, they don't have the expertise or the time to make that work. And you need to know, put it this way, I wouldn't personally buy shares in individual companies, because I think to make sure you understand all the risks and make a good job of it and actually probably make money ultimately, is you need to spend a lot of time analysing all these company accounts, etc. So I think for most people, you invest in what they call a collective. So you end up buying something which is effectively a fund, pooled money, okay? So all the millions of people around the country, rather than them go and buy shares, what they do is it's kind of clubbed together, and a manager runs that pool of money, and he goes and decides which companies to invest in. You just give him his money and you take your share of the profits. That's a kind of very basic idea of how that works. And of course, there's lots of people, lots of fund managers out there for lots of different investment companies who you could put your money with, and they have mandates and they have to report what they're going to do. So they may say they only invest in UK companies, etc., and that's all they can do, and it's stipulated in sort of rules, etc. So you with me now, Andy? Mm-hmm. Do you think the listeners are with me, more importantly? Because I know you've got a handle on some of this already.
I think they've got it. I think, we're going back to basics here, and you're winding it through a process.
Yeah.
It's working.
So you've got the idea, you're going to chuck it in one of these things, these pools of money, a fund. And there are a few ways you can do it. The simplest way is to get a tracker, okay? So there's lots of markets out there, like the FTSE 100, everyone knows about that. There's lots of other markets and indices. Some of them, you will never heard of most of them. And some will track things like the gold price or various really crazy things as well. And you can invest in something that just tracks that. Now, the wonders of computers, the internet, everything has caused the cost of these things to come down because computers can run them. If you've got to just track something and mirror an index, you don't need a human element in there. They used to have that in the past and they were still expensive to run. Now you can get these things for almost, well, barely anything. You're talking like 0.3% charge a year. Now, you could go for something like that tracks them, and normally they're things called exchange traded funds, ETFs. They trade a bit like shares, but all they do is they track an index. The next thing you could do, you can be completely DIY. You can be somebody who go, right, do you know what I'm going to do? I'm going to invest in my own funds. I'm not going to just put it in this passive tracker. That's what the type of investing is called. If you just go for a tracker, passive. I'm not going to just do that. I'm going to be my own man. I'm going to go and pick the fund managers I think are good and good at doing what they do. And I might pick some passives along the way as well, but I'm going to mix it up and make my own thing. And that's DIY investing. Of course, then you've got the next element from there is rather than have a fund, you could actually go to a company who will you chuck your money at them and they will pick funds for you and it'll give you a managed portfolio. And so there is that option, but that's more expensive and the decisions are taken out of your hands. So you might not want to do that because, to reiterate, you've got the index trackers. You've got to pick the index you want to track. You've got your DIY investing, the broader thing where you pick fund managers or a range of ETFs. You've got to pick you've got to make a decision there. The managed portfolio, all you've got to decide is who do I trust to run this for me. And then there's the other end of the spectrum. This is normally where it goes up. Sort of rich people, to want of a better way of describing it, people who normally have a fair few 100,000 have discretionary fund managers. And what they do is you get these guys swan in their suits and they say, hello, Mr. Leeks, you're very special to us. You're clearly rich. They don't probably say that bit, but we'll run your portfolio. We won't just stick you in a managed portfolio that everybody else has. We'll give you one that's a little bit special for you and basically make you feel better. I mean, give you nice freebies and things. So it's a bit like this is the investment bank world, okay?
Would I get invited out to special golf days and things like that, and to the tennis? Would I go to a box at the tennis and that kind of thing?
You would definitely. Is a definite possibility. I know. I don't mind admitting it. I've been to these things. I've been to companies where you end up going. They take their rich clients onto boats and to tennis and stuff like that, because don't forget these investment companies sponsor a lot of these events. Queen's is a good example. The tennis competition before Wimbledon, that's has various different
Aegon.
It used to be Aegon, I think it still is. And of course these companies, lots of companies will sponsor various elements of different tournaments, so therefore they end up having boxes and stuff like that they can take people to. So yeah, you could, when you go to the football grounds, when you get a program, they sometimes put in there who owns the boxes. Have a look and see how many investment banks or large firms that own those that are in the world of finance, and there's normally quite a few. Also, one or two law firms normally have boxes as well, so they're at it just as much as anyone else. So back to what I was saying. You've decided, you know what, Andy, I'm going to be a passive kind of guy. I'm going to go for an ETF, a really good one. Or you might say, I'm going to be an active kind of guy. The point is, you need to, if whatever one you've picked, you've got to decide on how you're going to invest. So it's a kind of an asset allocation. Now, that means, are you going to go all UK equities? Are you going to go all American equities, a mix? Are you going to go bonds and that sort of thing? For most people, they won't know the first thing about doing that. Now, the managed portfolios or the discretionary managers who take a lot of money off you, they'll do that for you. So if that's what you want, great. And I'll come back to those discretionary managers and the managed portfolios, because there are some cheap ones out there now, which there never used to be. It always used to be really expensive. So how are you going to get asset allocation? How are you going to find out where to invest? Well, you could use something like 80/20 Investor. It's a shameless plug, because that's the sort of thing I teach people how they do it and how they run their own money. Another way is you could go and look at some of the funds out there, like Vanguard have some very good tracker funds that are very globally mixed, the life strategy funds. Go and have a look at those. You can see how they're split. There are one or two sites that will have asset allocation tools, and not many of those actually out there. And so Google those. I'm building one, by the way, for Money to the Masses, so people can use to try and work out where they might want to put their money. So you've got to work out where you want to put your money. So look at one of those tools if you can find them. Like I said, as a default, Vanguard is not a bad model to have a quick look at. And have a look at, the other thing is, go and find a managed portfolio. Now, Hargreaves Lansdown do a few, because they are a platform and they allow you to do your own thing, but they actually pick and mix. But they do have some off-the-shelf type portfolios. Now, have a look at those, because you can see how they run them, how they've got balanced versions. So go and look at those. Google it. If you go on their site, you'll find them. Look at what they're investing, and that gives you a nice idea. So if you compare those to something like Vanguard, you've got a good start. So let's assume you've decided. There are some people who go, do you know what, Damien, I know the tracker I want. And there are some people now who are thinking, I know the funds I want, because I've just gone and taken out a subscription to 80/20 Investor, because it's incredibly amazing and incredibly good value for money. And actually, that's true, because that's what the research we did for users said. That isn't just me making that up, although I am biased, of course. So they know what they're going to buy, okay? Now, how do they buy it? This is the key thing. How do you do it? Now, how you buy an investment is you have to use something called a fund platform. And that's a bit like, to use an analogy, it's like you deciding you want to buy, I don't know, a bag of sugar. That's the fund. You've got to go to a shop to buy it.
Yeah.
And when you make that decision, you're going to think, well, do I go to the corner shop at the top of my road? Well, he's quite expensive, but he's convenient. Or do I go to Tesco's because I've got a wider choice of products there and they're always cheaper, or something like that. Tesco's probably aren't cheaper. I should have said Lidl. But that's what these fund supermarkets are called. Fund supermarkets, investment platforms, fund platforms. It's the same name for an entity like Hargreaves Lansdown that allow you to buy whatever you want. Now, there are about 21 or 22 of them out there. And it's very hard to compare or decide which one to go for, because they all do different things.
Can I ask why so few in relative terms? It seems to me that it's quite a good game to get into. Do you have any idea why so few?
Yeah, good, great.
Or is that a lot? I don't know. I'm not really got anything to compare it to. So.
Do you know what? That's a brilliant question, because it doesn't sound like a lot. But if you were to use the comparison to supermarkets, it's like having 21 chains of supermarket. Now,
True.
The difference is with fund platforms, when you look at the charges, what happens is you go in there and buy the funds. So you decide whether you're going to have a range of funds, or you're going to have an index fund or whatever, or you're going to pick one of their off-the-shelf portfolios, because some of them, like I said, do have off-the-shelf portfolios. What happens is they take charges for doing all this, and one of the charges is very small. They'll take a platform charge. So of the money you invest via them, they take a small profit, just like supermarkets do. When you buy food, there's a cost they bought the food at, isn't there? And they put their little profit margin. But the profit margin...
Pretty good analogy, you know.
Oh, thanks.
No, but it's helping me to understand far easier now you using the supermarket analogy.
And what they do is they take that small profit margin, but it's so tiny. I mean, we're talking 0.1% or something like that, 0.14. It depends on different platforms. They have different charges. So you can see, to be profitable, you need to be a monster. you need to have an enormous platform size. It's what they call assets under management, and it's why when you go on a train, you see adverts everywhere. It's the same reason why if any of these platforms get hold of you via email, so they say you give them their email for something, they will bombard you because they need your money. So if you were to give them £100,000 of your money, which is a big sum, they don't make a huge amount of money off that, because a lot of these platforms don't have their own funds. So like Tesco's, they will try and make more money by making their own versions of cornflakes, don't they?
Yeah.
Well, some of them do. So Hargreaves do, for example, but lots of the others, Fidelity do, but lots of the others don't, and that's the reason why they struggle, because they've got to get so much money under management. Now, to make a go as a platform, you're going to need about, I reckon, as a conservative estimate that I've seen out there and banded around, about £2 billion. So you need to attract £2 billion worth of money to be able to run the platform, to pay the wages, all the admin, because it's still very clunky. It might look slick to you when you're on the site, but there's a lot of admin paperwork, because all the investment houses, it's a bit like Tesco's. You don't see all the people who go and buy the products in the background, all the buyers, all the people visiting.
And then stack the shelves, don't forget.
And then stack the shelves.
It all happens at night time.
Yeah, it's exactly a similar thing. Obviously, you don't have people stacking shelves, but it's the same idea. You've got all that going on in the background, and there's a lot of, the world of finance is very clunky. All the tech stuff doesn't really talk to each other very well, because they all built their IT systems independently. So
is that why there's often a delay when you're sort of selling funds and getting monies transferred and stuff? It's all that admin, the clunky stuff that you don't necessarily appreciate.
Bang on. It's exactly that. But the problem is there is an element of where they will drag their heels because you're moving your money, but part of it is because there are different systems all talking to each other. So it's not just about dragging your heels. That's why anything in finance becomes very, very difficult.
So have we identified here an opportunity?
What?
Building something where everyone talks to each other simply?
Well, Andy, you should be up there talking to the industry and the FCA, because one of the things, they had the current account switching service.
Yes.
That came about to make it easy to switch accounts. One of the problems we have is people can't switch platforms. So you're going to choose one of these 22. Let's say you do. Just because you shop at Tesco's today doesn't mean you're going to do it forever, and people do change their mind as they their life moves and the amount their money they have, etc. So it's a bit like platforms. Once you get embedded with them, it's hard to get out, because some do have exit penalties. Hargreaves is one. There are others that do, but there is a movement to stop that. So if we are able to make it easy for platforms to talk to each other, there was some new technology a few years back that was meant to make it easier. It would be wonderful. But going back to your original question, as I've just remembered what you asked me, is that the reason there are so many is people are trying to get into the market because it is lucrative, as you say. If you go in there, in theory, you can just skim money off of all this billions of pounds of investing that's going on. And the other point is the reason why, in a way, there's only a few big players, is because you have to have that huge sum to be able to do all the marketing and all that bump that goes with trying to run one of these machines, and they can't compete. So there are 21, 22 of them, and some of the ones you've never heard of will be the cheapest for you, but it's very difficult to compare. So the point of all this, if you go to Money to the Masses, we have just launched a calculator on our site that compares these things. So you go on there and you put in how much you want to invest in the SIP, ISA, both, outside of an ISA or SIP, and what you kind of want to do, and it will press go and it will tell you who is the cheapest out of all of them. So
you've created Money Supermarket, but you've created Money Finance Market.
Well, technically, I haven't created it because we've partnered with somebody who has made it. So somebody approached us and said, I think I dropped a hint previous week that we were in talks with people about it, and we liked what they were doing. We were doing it anyway. We were doing it manually, talking about it, doing manual calculations, and then we said, look, there's a calculator here that works well. So go and have a look at it. It works. It compares them all. It's independent. There's no hidden tie-ups in a way that some people have on these. There's always a danger, I think, with comparison sites, is that they will promote the one to the top that they get paid the most money. Now that doesn't happen with this, because we were very deliberate about that when we got into the partnership. Because do you remember there was lots of comparison sites that were doing it with car insurance? They were putting the one up the top that they got paid the most on.
A very biased algorithm.
Yeah.
Okay, so how will listeners find that?
If they go to moneytothemasses.com, there's a compare tab. Click on compare and it will drop down. It will say fund platforms. Click on there. boom, you can have a play with it. And
Excellent. I'll link to that in the podcast notes too.
so even if you have a fund platform, check, because it may be cheaper for you to move elsewhere. The key things to remember before I move on quickly are that the cost of the platform will vary depending on your how much money you have, what you want to invest in, because if you want to invest in different types of investments, say shares as well as funds, there are people who want to do that, there are different charges. Of course, it isn't all about being cheap. I'm a big advocate of not just going for cheap on everything, it's about value as well. So I just want to quickly rattle through a few things if you're considering a platform, because the guy who inspired this question said he found it difficult. I've told you how to find the cheapest, but there are other things to consider. So for example, very quickly, customer service, you need to look at the administration, how slick the site is, whether it works, if they have an app if you want it. There are plenty of platforms out there that are very clunky, so once you start using them, there is nobody at the end of a phone line, as there are with some of the bigger ones, who can resolve your problems. It is going to be almost not a man above a chip shop, but it's going to be a much smaller team that's involved, and so the gloss that you see on online probably masks a much smaller entity. There's nothing wrong with small, but it's just you've got to, if that's going to bother you, then bear that in mind. Is there any tools or research? If you're using 80/20 Investor, my DIY investment service, you probably don't care about the tools and research, to be quite frankly, because you'll love what we're doing. But if there are some that do it, on the charges front, that tool that I was talking about will compare charges. But if you bear in mind anyway, because it can't compare every scenario, but look at transfer charges if you want to transfer away, if the platform that you're liking is going to charge them. If you're investing in shares, do they charge you to reinvest dividends? Some do. Some actually have a service where they can do reduce the cost by doing it on bulk. Are there charges for buying and selling funds, switching funds? There shouldn't really be these days, but there are some that still do. Are there what they call bid offer spreads on funds? Google that if you don't know what it is. Find out what the fund manager charges are, what the platform charges, because obviously the way the charges, unlike Tesco's, when you go in there's one price, they have to break down what the prices are, so who's getting what. And you can see that, so because you can buy the same products anywhere, that's pretty much standard. There are some availability differences between the platforms, but the ones that most people buy you can get anywhere. And check to see if there's any other caveats about the way fees are taken. Are they taken from a cash account? Do you have to have cash sitting there rather than invested, where the money comes from, or do they take it from your debit card? Because there are some platforms that will take it from your debit card rather than from your invested money. So make sure you know which is which when you start out. So we've done the what, we've done the where, the kind of asset allocation, and the how, which is the platforms. And you can find any more information about this on Money to the Masses. I've done various bits and pieces. If you go onto the Money to the Masses site and search in the search bar at the top, cheapest and best SIP, there is a roundup of all this stuff. And the reason I say best, because there are best SIPs for people who are doing monthly investing. There are best ones for people who want tools and functionality. There are people who are doing like large sums. And there are some for people who want managed portfolios. Now, I'm going to quickly jump back to that on the managed portfolios, because there are people who want to just say, do you know what, I want the DIY investing benefits. So one of the big advantages of DIY investing is you can keep your costs low. Keeping costs low will actually make you, or save you so much money in the long run. It's an incredible amount when you scale it up. You're not just talking about a few thousand, it's tens of thousands over significantly large pots of money. And you can do that by keeping them low when you're building your own portfolios, if you're doing the DIY stuff, or if you're picking an individual tracker. The problem is with trackers, you don't want to put all your eggs in one basket, do you? So you might say, I would love it if somebody would pick those trackers for me and put them together in a bundle, because trackers are cheap, ETFs are cheap, that's because they're run by computers, but build a package together and then charge me hardly anything for it. Now, there are people who do that. There's a few new entrants in the market. The problem that most of them have, they have high minimums. You have to have at least £500 to get going. So if somebody wants to invest £25 a month, you can't. There is one that I know of, Money Farm, who we've talked about before and has sponsored the podcast. They do no minimum, and they don't do a charge on the first 20,000 if you go and when you sign up, put MTTM 20k. The discretionary managers I just touch upon those. I wouldn't really deal with those if I were you, for most people, because they don't actually outperform. There is enough statistics out there to show that they end up buying very expensive stuff, and you could probably beat them, inevitably beat them, by buying cheaper stuff and doing it yourself. And
unless, of course, you want to go and watch the tennis.
Unless, of course, you do. I tell you what, I saw something funny the other day. I was on Twitter, and somebody wrote, "I can't believe how much this glass of wine has cost me. This glass of wine I've bought a client has cost me in the city." And I didn't say anything, but I did chuckle, and I thought, well, nothing technically, because the client's ultimately paying, isn't he? But that would have just been, it would have been true for starters, Andy, but it would have been a little bit provocative. One thing I forgot to mention, I'll quickly go on to, ISA pension. So we did what they're buying, where they're buying, how they're buying it with a platform. It's the vehicle, because you buy a fund, you've got to think where you're going to put it in. Is it going to be in an ISA and a pension or nothing at all, because you can buy funds directly. Now, generally speaking, I wouldn't buy directly a fund because you're going to have to pay tax on it. The beauty of ISAs and pensions is that you can make switches and changes, and all the growth is tax free. Which is better? I'm always asked which is better. Now, it's kind of horses for courses. Now, just to give you a roundup, on a pension, the beauty of a pension is that you get tax relief on the way in. So if you're a basic rate taxpayer, it's 20%. If you're a higher rate taxpayer, it's 40%. So you can put money in and you get basically a free buffer from the taxman, because you're claiming back the tax. And so that's great. So 80 quid you put in, your basic rate taxpayer gets topped up to 100. That extra money grows then and compounds tax free when it's growing inside your pension. Issue is, when you get to the other end, you are taxed when you take it out, unless you make yourself a non-taxpayer when you come to take it, when you come to draw your pension, which actually is easier than you think, because you're no longer working, presumably, and you can arrange your affairs so you actually can take out your pension, not pay any tax. There is a limit. You can't get your money out when you want, because you have to be over 55. Although once you're over that, you can cash it in, but there are tax implications. Now, an ISA, for young people, I quite like ISAs. And I know there are people out there who just go, oh, I always get a pension. The beauty of an ISA, okay, is that if you're young, you don't know what you're going to need the money for, because there's so many expenditures that, I mean, it's so expensive, isn't it, when you're young? You've always got children, you've got boilers that blow up, you've got cars that break down, and your income is probably not at its peak. Unlike when you're slightly older, your income will be higher. Hopefully your expenditures may have dropped, and you don't actually spend so much on your kids, etc. So I like ISAs. Although you don't get tax relief when you put money in them, in a bog standard ISA, you don't get charged any tax when you take the money out. And again, the pot grows tax-free. Now, one thing people overlook is that you could save in an ISA for a while and then think, do you know what? This is okay. I don't need this bit of money now. You could cash in that ISA, and you could then pay it as a contribution into a pension. Of course, you've lost the ISA status, but you'll end up in a pension. As long as you've got enough earnings to get the tax relief on that amount of money, you'd get the tax relief on top of that. Does that make sense? So you can do, it's not a one or the other. You can do one, as in an ISA, then the other, or you could do both. So there's no right or wrong answer in that. So either would like ISAs. My view is that you should use one or other. If you get near, people always seem to think the younger you are, you should use a pension. Ironically, you could be really old and get a pension, because you get the tax relief and you could then just cash it in not long after, and then you actually just got a nice bit of tax relief that you can take out. So there are rules around that, but effectively that's what you can, and people do. So there is no hard and fast rule. I'm a bit of a fan of the ISA then pension for young people, but the key thing is, if you're young and you want to invest even £25, I would start to say, look, go with a tracker of some kind. The life strategy stuff that Vanguard do are great. I'm not recommending those because I don't want to give people financial advice on the podcast, but have a look at them. There are equivalents. They are great. You can build up your fund. You'll need to still buy them via a fund supermarket that has got no minimum at all, because if you want to try and buy most funds directly, there are huge costs. Vanguard are bringing a direct-to-consumer platform themselves in the new year, I think it is, which will be really big. I mean, that's quite a move into the market. So
that's a bit of a game changer, isn't it?
It is a game changer, because it's a bit like, I'm trying to think of, it's like,
come on, let's go back. Let's get a supermarket analogy. Come on.
I'm trying to think of one. Let's say, I tell you what the equivalent of is if Tesco's had a supplier, okay, they used, and that supplier provided them with their most popular products. So in this case, Vanguard is incredibly popular. That's some of their life strategy funds, and a lot of advisors use them. It'd be the equivalent of the supplier going, do you know what, I'm going to launch my own supermarket and only sell my own goods. Because that's what everybody buys, and then they undercut Tesco's because Tesco's can't sell them any cheaper than the supplier can, because they, do you know what I mean? That's what they could do. So the equivalent is a game changer. It could be. The only thing is you can only buy Vanguard funds through the Vanguard new platform, and let's be honest, I'm in the whole passive versus active. There's a good point actually I should cover on this. Passive versus active. Should you go passive investing or should you go active? So do you go for computer trackers that just map an index, or should you put your money on a manager who tells you he's going to make you a fortune? Truth is, I think you should do both, because as long as you look at the returns net of charges and how much money they make after charges, then the charge is slightly irrelevant. A manager needs to make enough money to make it worth your while. That's why on 80/20 Investor we don't care. I don't care about passive or active. I don't have the label. The reason the labels exist is because when you read the newspaper, the passive people want to say, you want to buy these cheap trackers and not the managers over there who will be making all the money. So they'd call them active. And equally, active people say, oh, you don't want the passive stuff because, and they come up with some reason that, oh, you can never beat the market or something like that. And that's why it exists. Do you know what I mean? It's almost like two sides of a football match. The fans are on one side and the other, and they shout at each other.
Yeah.
Reality is, I don't draw a distinction. You buy what's working, and in any environment, not one will work. Typically speaking, of managers at any one time, there will only be a handful that are beating the market convincingly, and therefore you need to review. The last point of this investing 101 is review. Get your portfolio, you've got to check it. You can't just leave it, because not every dog has its day. Even Neil Woodford, the most famous fund manager it seems in the world, will underperform massively for periods of time. Whereas why would you stay with him? Why would you not go to somebody else who's doing well and then go back to him when what his process is doing well? It's just like, again, if you want to use a football analogy, if a team, when they're on form, you back them. When they're not, do you know what I mean? You won't put your money on them.
I've got a supermarket analogy.
Oh, good, Andy.
You wouldn't necessarily just buy 100% luxury brands. You wouldn't buy necessarily, unless you're on a really, really strict budget, 100% value brands. You kind of want a good mix. You know what works and what doesn't. You get the odd value. You get the value beans because you know they're just a small little item. It doesn't really matter, and they kind of do. You get the real luxury, I don't know, tea bags because you like a cup of tea in the evening. Passive versus active. A good mix of both and you're happy.
Yeah.
Does it work as an analogy?
It kind of does, because don't forget...
Oh, come on, give me more.
No, because
what you're saying is it doesn't work.
No, it does, because obviously there will be times when even the active is better than the, like, cost-wise, than some of they'll do deals, and it's the same thing. So you can, you get these people who, using your analogy, Andy, who shop around and still live like kings and yet not spend any more than, do you know what I mean? It actually can be better than... stretch your analogy, than the value beans. But yeah, the point is that you don't pick one or the other. I would just go with whatever's working, and that's what 80/20 is all about. So I hope that's made it clear for people the journey. What would have happened is that the advisors would have gone the other way around. They would have gone, oh, this is what you want to do. You need to invest now. Oh, that was the last point. When do you invest? Oh, quickly. When? That was the one thing I forgot. They would say now because they want your money and they get paid. I would say, don't try and time the market because you'll get it wrong. No one gets it right. I get it wrong. I don't try and time it. Sometimes you get the luck, sometimes you don't. I would say that you would drip in. If you think the market's going to fall, you need to drip in, because then you get more bang for your buck, to use a really naff term, and the way down, because you buy more funds, more units in your funds, don't you? So when it bounces back, you make more money. And if you think the market's going to take off, then you invest all your money at once. The truth is, you don't know what's going to happen. So I would just invest your money in instalments. And we did a podcast on this very point, probably about 4 or 5 episodes ago. So go back and have a listen. So I would say, if you're at market highs, you can't predict the market, drip in. There's no rush. Because if you're going to invest for 10, 20 years, there really is no rush to invest. And let's be honest, if you're going to invest that long, you don't have to worry about dripping for an extended period of time anyway, because the point of that other podcast really was that the longer the time frame you invest, that's going to have the bigger impact than when you invest. So that's it, Andy. I hope everybody's going to email in and tweet me saying, Damien, you've answered all my questions on investing. But it's a complicated topic, and to try and nail it down in such a short period of time, I hope we've achieved it.
Good. I learned lots. I learned lots about supermarkets, ironically. Excellent as always. Are we done for this week?
We are done, Andy. That is it. I think we've probably fried a few people's brains, so we're going to let them off. We're going to let them out of class early. Actually, it's probably not early. This is probably slightly longer than most podcasts, but never mind.
Have we fried people's brains in oil from which supermarket, would you say?
I would say it was I would say it was a very premium brand, actually, Andy. So what's probably something from, I don't know, what is the top supermarket chain?
Well, I would say it's probably a luxury bespoke, maybe a flavoured oil from Waitrose, as opposed to crisp and dry from Lidl's.
There we go.
See you later.
See you later.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.